since 1950. This is in current value terms, so not adjusted for inflation. So over the past, but you can't even see what the numbers are in 50s, 60s, 70s, and 80s, right? It just skyrocketed. Now, the way to properly answer the question of what do the trends look like is you've got to normalize a lot of things. And so I use this company, I like this company, it's called Current Market Valuation, right? It's a subscription and I subscribe to it. I'm not endorsing them, just as I'm not endorsing Berkshire Hathaway and Warren Buffett, right? I mean, you invest in those companies at your own risk, again, that's my disclaimer. But one way to track the market to determine whether it's overvalued or not is to normalize it and then trend it. And so what do we mean by normalizing it? So if the stocks in 1950s, 60s, and 70s were in 1950s, 60s, and 70s dollars. Those dollars are different from dollars in 2024. What do we mean by that? It means that a dollar that you earn in 2024 does not have the same spending power as that same dollar in 1950. There's some of you who are shaking your head, you're like, hey, I remember when I could buy a house for $20,000. I'm tough, those days are gone, right? But if I were to normalize, in other words, take a 1950, 60, or 70 and then convert it to 2024 dollars, right? So reframe it in 2024 dollars, this is what the stock market would have looked like by putting the earlier years in 2024 dollar terms. And then the next way we do it is we exponentially trend it. Why do we do exponential trending versus straight line trending? Because the market's returns compound on each other, right? So 1% compounds the next year, it's not going to be 2%, it will be 2.1%. And then 3.2, it compounds. So because you're compounded not the principal, but the principal and the interest. Does that make sense? And so to do a trend analysis, you've got to do an exponential one to take into account the compounding effect. So if we did that, the stock market's value in 2024 should have been, notice the word should, right? I'm getting into a normative statement here, not a positive one. Should have been 73% lower than it is today. Said another way, the stock market at the end of 2024, and I used the January 3rd, 25, that was a Friday, and this is when they published these data on a Friday. It's 73% higher than what its true long-term trend should have been, which is somewhere around the mid-3000s. So that's the first question we ask ourselves. And we can look at this through multiple lenses. I'm going to show you them in a little bit, right, in more detail. You can see that we had one peak in the market around the year 2000. Who recall what event occurred around the year 2000? The dot-com bubble. We're not talking 9/11 now. That was a non-financial event. The financial event was the bursting of the dot-com bubble, right? So during the mid-90s, we had all these technology stocks, internet-based stocks, that were just skyrocketing. And then on March of 2000, the bubble started to burst. And it had multiple bursts, right? It was a big balloon. And then it crashed, and then what we had was another run-up. This one prior to the what? The Great Recession that they call it, right? So the Great Financial Crisis, we had the subprime mortgage effect, the market got ahead of itself again, and then that effect, the collapse of that caused this. This had a very particular event, right? And that was when we had a number of companies beginning with Countrywide Financial and a few others that started to collapse. So there was an actual event that precipitated this. There was no actual event that precipitated this. The market just got ahead of itself, and then and many people might have recalled Alan Greenspan's great comment in 1996, somewhere around here. Irrational exuberance. He said the market just get irrationally exuberant, and the market just started to correct itself. Again, there was no external factor that precipitated it. But then we had another event. So we had the financial crisis. Then we just started to have another, it just kept going up, right? There were some moments where it went down and up, but it just kept go all the way up.
Be prepared.
What was this? By the way, this one was the crash of related to the COVID, right, in 2020. But what precipitated this at the end of 2021? This was the COVID bubble. So it turned out the economy, the government had spent so much money in the economy. That was one. The second thing was consumers who were at home not spending money. The moment they were able to get out and start spending money, that was a pent-up demand in the economy. And that was what unleashed the inflation of 2022, right? But it was the rise in the stock market of 2021, pent-up government spending, pent-up consumer demand that was unleashed from 2020. All of that just flooded the market at the same time. And it led to a huge run-up in stock at the end of 2021 that had a subsequent huge correction in 2022. But of course, we didn't learn our lessons, so we're having another major run-up again in 2023 and 2024. And so the question is, how long will this last? That's the question. So if we do a trend analysis, we can see the market is way ahead of where its trended return should be. So I'm going to show you 4 different analyses to answer this question, and then let you come to your own conclusion. But this is analysis number 1. Analysis number 2, to answer the question of is the market currently overvalued, is looking at it through the lens of price to earnings ratio. So for those who are not as familiar with stock investing, price to earnings ratio still remains the number 1 method to use to value stocks as to whether they're overvalued or not. So how do we get price to earnings? We look at the actual price of the stock and divide it by the earnings of the stock. So we call it price to earnings ratio. What's a good number? It's going to vary. Again, I'm an economist, I will always tell you that. But there are some objective metrics that we can look at. So you'll notice we're looking at what we call the 10-year price to earnings ratio. So let's talk about this because it's a very important metric. It's the most widely used metric to value, to ascertain whether a stock is overvalued or not. Traditionally, we use what we call trailing 12 months price to earnings ratio, or historic price to earnings ratio. But there's a problem with using historic price to earnings ratio because we're trying to determine if the P, or price, is too high or overvalued. So it means we have to use an E, or earnings, that is appropriate. Well, what do we mean by appropriate? Right? Now we get into another normalized term. What does appropriate mean? It turns out in any given year, a company's earnings goes up and down, just like its price. The earnings can fluctuate. A company can have a good year, the economy can do well, and likewise a company can have a bad year, the economy can do badly, right? So a lot of things can affect the earnings of a company. So if we look purely at a historic price to earnings ratio, we may not always get a good measure of whether or not that's a fair value. The number, if the earnings is low in a particular year, and I'm trying not to get into the math, but if the earnings falls, then the price to earnings can go artificially high, but it doesn't necessarily mean that the company is a bad investment because the PE is too high. It just means that the earnings that year was too low, and the earnings might pick up the next year. Conversely, a company might have a very good year for different reasons. I'll pick NVIDIA as an example. I'm picking on them, don't sue me. NVIDIA is doing phenomenally well now. Now their earnings are projected to also do well, but the price has gone way higher than the earnings could ever justify. So their price to earnings right now is phenomenal. It was about 100 something, I think it's down to 50 or something right now, but it's still relatively high. So it's hard to get a gauge on historic price to earnings because we don't know what the true earnings should be. What many investors these days are looking at is what we call forward earnings. So what's the earnings the next year? Next year's earnings. Now, I'm going to go on record as saying I don't trust those estimates because they're based on assumptions that are very wild, often overly optimistic, and most of the time does not make sense. You remember when we talked about fundamental analysis, how fundamental analysis is performed? Fundamental analysis looks at forecasting the revenue of the company, forecasting the cost of the company, measuring its cost, looking at how management, you have to look at management's goals and objectives and their strategy when you try to determine earnings. Most of the time, we'll never know all the details about a company's revenue prospects, cost forecast, what management thinks, and less we will know trends and developments in the industry or the macroeconomy. How will Trump's tariff policies affect the economy? Economists are divided on that. We don't really know. So those will affect the forward earnings of a company because we don't know what the macroeconomy is going to look like. So as much as it's a good idea to try to estimate forward earnings when we do price to earnings, it's nothing more than an educated guess. So an economist named Robert Schiller, a Yale economist, won a Nobel Prize incidentally a few years ago. For those of you who follow the housing market, he created some housing index. He came up with a concept that looks at 10 years average earnings. He called it CAPE, meaning cyclically adjusted price to earnings. So if you take the 10-year average earnings, you eliminate the highs and the lows in the earnings for that period of time. And you get what he calls a normalized earnings. So when you do a 10-year average or normalized earnings, now you get a much better idea if a stock is too high or too low by looking at its price, current price, relative to that normalized 10-year earnings. That make sense? And many economists find that to be a much better way of measuring the true stock's value or worth using its normalized earnings. So the 10-year price to earnings ratio. Now we're going to put another concept in here. Again, go back to your high school and college statistics. I know it was traumatic, but just try to get back. And we're going to talk about standard deviation. Fun times, right? So to really understand whether something is overvalued, we look at it in standard deviation terms, around the mean. So the mean of the historic price to earnings ratio, the mean of 0, we're going to call it that. And if we have a standard deviation of 1 standard deviation above the mean, then we say the definition is we believe that market overall or the individual stock is overvalued. But if it goes 2 standard deviation above the mean, now we're talking about an extreme outlier. That's when we talk, and if we go 3 standard deviations, that is an absolute, it's a very, very unlikely event. That's a 3 standard deviation. But 2 standard deviation is typically what we look at to determine in this case, if it's 2 standard deviations above the mean, then we believe we call this overvalued. And so if we look now at the stock market, and I'm putting it logarithmic terms so we can see better. So if you recall the last chart where we had it trending up, now we're just putting it flat because it shows better. Here's what we see. There were only 3 times since 1950 when the stock market actually hit what was called this strongly overvalued territory. The first was during the dot-com bubble, and it actually went so far as 3 standard deviations before we all know what happened. It collapsed back down and went back to almost its historic norm. The second time was we call it the COVID bubble at the end of 21. It again went over 2, went 2.2, 2.3, and then came crashing back down in 2022, end of 2022, went back down into what we call fair value territory, and now it's doing another run up, and at the end of 2024, it's about 2 or a little over 2 standard deviation, about 2.1 standard deviations above its historic norm. So again, using the 10-year CAPE price to earnings ratio, we are seeing that the stock market, again, measured by the S&P 500, is in rarefied overvalued territory. That's the second way of looking at the market. The third way and I'll quickly wrap up. I want to leave time for any questions you may have. Is just looking at the actual value of the PE ratio. It's currently at a ratio of 37, price to earnings. Now, what does price to earnings mean? What does a price to earnings of 37 mean? It means if a company's earning a certain amount and its PE is 37, it will take 37 years. If the company keeps its earnings at the same rate, it will take 37 years for the earnings to actually match the current price. 37 years. Now remember, what a company earns is not all that goes to shareholders. What the shareholders get is what's called dividends, right? We typically value a stock in terms of cash flow. But what we look at is earnings drive cash flow, and cash flow determines dividends. So if it takes 37 years just for the earnings to get back to what the current price is, it will take even longer for the dividend payments to get to the investor. In this scenario, over the past 70 years, the historic average of the price to earnings ratio is a little over 20. Now, many, many years ago, that number used to be 15. Then I remember when the average was 18. Now the average is 20. The average has been pulled up because of the market has been performing very high over the past few years. So the average now is at 20, but it's still very high. But however we can look at this, what do we conclude? We can conclude that if the average of the price to earnings should be 20, the price should not be more than 20 times the earnings on average. If it's currently 37 times the earnings, that means the current stock market price is almost double what its historic norm should be. That's another way of looking at it, right? Just based again on looking at the trends where the 3 times it's ever gone above say 35 have been in 2000, the dot-com bubble, 2001, the COVID bubble, and now 2024, 2001 and 2021, and 23-24, this is the Gen AI bubble that's being driven primarily by NVIDIA, right? So it's Gen AI that has been driving this most recent surge. And then there's a final way to look at market valuation. What is overvalued? This one I'm going to get back to now. It's called the Buffett indicator. I mean, Warren Buffett should be paying me here. I'm really doing him a service, right? Yeah. But at the end of 2001, during the height of the dot-com bubble, Warren Buffett came up with this metric, very simple metric. He looked at the total value of all stocks in the economy. It's called market capitalization. And he divided that by the GDP. In fact, he divided it by the GNP. But again, that's a technical stuff. Don't want to get into that. But most economists now look at it in terms of the GDP. They're relatively similar in the US, so we're not missing anything. And what his metric asked was, how do we benchmark the value of the stock market relative to the size of the economy? Because the value of all stocks in the stock market shouldn't be much higher than the value of the overall economy, right? Just think about the logic of it for a second. When you look at a stock of a company, we measure the value of a stock in terms of its discounted cash flow, discounted to the present. So what we look at is, what's the company's earnings potential? And from that earnings, what is the cash flow, or what we call, technical term, free cash flow coming from those earnings? And then can we discount that back to the present time to get to a fair or intrinsic value of the company? That's how most financial analysts look at it. Think about it. Every company operating in the economy, if we discount back their earnings and their free cash flow, should those companies' total value exceed that of the US economy? Probably should not. Although we are talking two different things. We're talking a stock versus a flow. I admit, I understand that, right? So if we get into a technical thing, one's a stock, one's a flow. But look at the history of the US investment economy, right? Since 1950. Admittedly, we don't have this during the 1920s when we had the great crash of 1929. Maybe things were different then. I don't have the data on that. But if you look at it, even during the dot-com bubble, the highest stocks ever reached as a percentage of the US economy was 1.5 times. That was the height of the dot-com bubble in 2000, 1.5 times. Now, we're at a point, the post-COVID bubble, we were a little over 2.05, and now during the Gen AI bubble, we're actually at 2.1 times the size of the US economy. This is something Warren Buffett came up with to ask the question, how do we know the market as a whole is overvalued? We call it the Buffett indicator. And as you can see, at 213% or 2.1 times the size of the US economy, it's the highest it has ever been in our recorded financial history. If you trend this metric, then you could see that we're currently 68% higher than what the true long-term trend should be. Again, this should is a statistical analysis, but it just points to the fact that looking at all four metrics, probably not a gross exaggeration to say the stock market currently appears to be overvalued. In which case it might be due for a correction similar to what we saw after 2000, where the ingredients are very similar to what we have today, or after 2021, when this was just pent-up demand being released in the economy. So what do we do about it? So first of all, before we talk about what we do about it, why is it currently in an overvalued state? Well, since 2023, the beginning of 2023, 7 stocks have really driven about 58% of the total S&P 500 returns. 7 stocks. They are called the Magnificent 7 stocks. Let's look at their performance over the last 2 years. In 2023, the market as a whole grew 24.2%. In 2024, it grew 23.3%. But each of these stocks did phenomenally better than the overall market in 2023. Only one of them performed less than the market in 2024. If you were to take these 7 stocks out of the S&P 500 and then just look at the other 493, the S&P 500 would have only gained 9.2% in 2023 if these 7 stocks were not in there, and it would have only gained 10.8% in 2024, again, if we took these stocks out. So these 7 stocks alone are driving this phenomenal return in the stock market. One more bit of information. The S&P grew over 20% in back-to-back years for the first time since, take a guess.
Dot-com bubble?
Since the dot-com bubble in 1999. That was the last time the S&P 500 had 2 successive years of 20+% return. So do with that whatever you will in terms of what to make sense of it. A couple of things I want to point out though, quite interesting, if you take a look at it, how has each stock performed in 2024 relative to 2023? Each stock, how have they performed?
Less.
You're all trending down. You see that? Even the great NVIDIA, you're all trending down in 2024 relative to 2023. And so, it's interesting to see where the trend in 2025 is heading, and ultimately what the impact on the overall stock market is likely to be like. So, in summary, we can say we looked at 4 metrics on the US stock market as measured by the S&P 500, and it clearly trends to a very overvalued market. So really, there are 2 questions to answer. I'm sure you're thinking about them, so I'll think about them for you. How long will this overvaluation last, and what should you do about it? So let's talk about the first one. How long should the overvaluation last? There's a great economist by the name of John Maynard Keynes. You may have heard of him. great British economist. But this was not in his economist role. He used to also be the investment manager for the funds at, I believe it was Cambridge University. And as the investment manager for the funds at Cambridge University, as you think of every college nowadays has an endowment fund. So he managed Cambridge endowment fund. I believe it was Cambridge. If I'm not, I'll get that right. But I believe it was Cambridge. And he had this great quote way back in the 1920s, almost over 100 years ago. He said, markets can remain irrational longer than investors can remain solvent. So markets can remain irrational for long periods of time. I'm going to go back and show you just a couple of things on here. If you look at, in fact, I'll use this one, which I think is a great way of looking at it. If you were to look at you could probably argue, I took 35 as the benchmark for overvaluation, but you could easily look at 30 as a benchmark for when a stock is overvalued. It's clearly overvalued. We discussed this before. We talked about the 1 standard deviation and 2 standard deviation. Right here is the 1 standard deviation. So I'll use this one then. So when it hit the overvalued mark, it hit this for over a 2-year period, where it remained overvalued for well over a 2-year period before it came back down. This was the COVID bubble effect, and this was overvalued for a period of about a year, where it remained over the 1 threshold, right? 2 is extremely, 1 is just when it hit the overvalued. There are other periods of time when it also went there. So we know markets can remain overvalued or irrational for long periods of time. It's really hard to, so if someone asks the question, how long will it last? You can't really say. But markets have been known to remain overvalued and irrational for long periods of time.